We're here to cut through the noise and get straight to the economic insights that matter to you.
Glad to be here.
Today, we're taking a close look at some recent comments from Bank of Canada Governor Tiff Macklem. We've got some great source material here, thanks to Mandeep Toor Real Estate Inc.
Yeah, and our goal today really is to unpack Macklem's latest thinking on the Canadian economy. We're going to focus on a few key things.
Okay.
His view on that big wave of mortgage renewals everyone's talking about, his surprising concern for renters, actually, and also how U.S. trade policy might shake things up here in Canada.
Right, so let's jump straight into that mortgage renewal point. Macklem said something pretty interesting, didn't he? He's apparently less concerned than he was a year ago about this deluge of renewals coming in 2025 and 2026.
Exactly. Especially for that big group, about 60%, who got those rock bottom rates during the pandemic.
Which sounds a bit counterintuitive given all the headlines, right? So why is he feeling less worried now?
Well, his reasoning really comes down to the Bank of Canada's own actions. He points out they've lowered the policy rate pretty significantly over the last year.
From 5% down to 2.75%.
Precisely. So Macklem's framing is that these renewals, for many people, are a shift from like an exceptionally low rate, maybe 1.5%, to what he calls kind of a normal rate.
So maybe 4.5% or 5%, something
yeah,
like that.
Somewhere in that ballpark. Still a jump, definitely, but maybe not the catastrophe it might have seemed if the policy rate was still way up at 5% or even higher.
But he did add that caveat, didn't he? I'm not saying it's going to be easy.
No, absolutely not. It's still going to be a squeeze for many households. He acknowledges that.
Right, because incomes haven't always kept pace, other costs are up.
For sure. But there's another layer. He mentioned the stress test. Remember, most of these borrowers were actually tested to see if they could handle rates that were higher than what they initially got, often 2% higher, or at least 5.25%.
Okay. So if they're renewing now into, say, a 5% environment, they were technically pre-approved for something similar or even tougher.
Exactly. It's like a built-in buffer. It doesn't eliminate the pain, but it does perhaps reduce the risk of widespread defaults compared to what might have happened otherwise.
Okay, that makes sense. So while it won't be easy, the system might be more resilient than some feared regarding mortgages.
That seems to be his perspective, although we should touch on delinquencies quickly. They have gone up.
Yeah, I saw some data on that. Equifax noted over 11,000 mortgages in Ontario missed a payment in late 2024.
That's right, nearly triple the number from 2022. So there is stress building.
But Macklem's point.
His counterpoint is crucial context. He emphasizes that even with that rise, delinquency rates are still below pre-pandemic levels.
Okay, so rising, yes, but maybe not at crisis levels yet, viewed historically.
That seems to be the interpretation, more like an adjustment maybe than a collapse.
Right, but this brings us to what I found really surprising. While he's less concerned about homeowners renewing, he flagged renters as a bigger worry. That kind of flips the script, doesn't it?
It really does. It's a critical point he made. He specifically said renters appear more at risk for falling behind.
And why is that? What's the evidence?
Well, he pointed to data showing late payments by renters on other kinds of debt, like car loans, have actually climbed above pre-pandemic levels.
Okay. So while mortgage arrears are still relatively low, historically, renters are showing signs of strain on other financial fronts already.
Exactly. Renters don't have that home equity buffer, and they weren't stress tested on their rent payments in the same way homeowners were on mortgages. So if your rent is high and rising and your car payment is becoming harder to meet.
It's a tougher squeeze with fewer safety nets.
Oh, okay. I
see it.
Yeah.
It's a different kind of vulnerability.
And connecting this to the bigger picture, Macklem also talked about U.S. trade policy recently, right? Linking it back to potential economic headwinds for Canada. He did. He spoke about the potential impact of what he called a dramatic escalation in tariffs and pervasive uncertainty, particularly thinking about the previous Trump administration's approach.
And the potential fallout for Canada.
He outlined things like, trade disruptions, obviously, potential job losses, consumers getting nervous and spending less, and possibly higher prices for imported goods, which wouldn't help inflation. Basically, a drag on the economy.
But there was some recent news on that front, a positive step.
Yes, thankfully. The recent agreement between Canada and the U.S. to negotiate a new economic and security relationship within 30 days, that's seen as a move towards restoring some stability and predictability.
Okay, good. So, bringing it all back home to interest rates, the bank cut rates slightly back in March from 3% to 2.75%. What's the outlook now, considering everything?
Well, Macklem suggested more cuts could happen if the economy weakens further and inflation keeps heading down.
But there's a but.
There's always a but, isn't there? He warned quite clearly that if firmness in underlying inflation persists, if those core price pressures don't ease up, then further rate cuts become, well, much more difficult. It's that balancing act again.
Watching the economy, watching inflation. Okay, so lots to consider there.
Absolutely. Which leads us to a final thought for you, our listener. As all these global trade winds shift and our own interest rates potentially move, maybe reflect on this. How might these currents impact your financial situation differently, especially thinking about whether you're a homeowner versus a renter? It's clear the pressures aren't being felt evenly.